Live from Singapore, this is Insight with Haslinda Amin. For the next 2 hours, we'll dive deeper into the stories that matter, providing crucial context and sharp analysis.
New Blackwell that just came out, it's 10 years ahead of every other chip. But there's nothing to meet with other than say, congratulations. But no, we don't give that chip to other people.
President Trump putting to rest speculation that Nvidia's latest Blackwell chips will be sold in China, saying they won't be available to anyone else. How will the restrictions affect China's tech ambitions? We'll ask Duane Kuang, founding partner at one of China's most iconic VCs, known for backing Xiaomi, ByteDance and Meituan in their early days. With a Fed rate cut in December looking less likely, we gauge the outlook for the U.S. property market with Eldridge Acre partner CEO Warren Wachsberger. And as Indian equities hover near a record, we hear from the MD and CEO of one of the country's largest money managers, HDFC Asset Management. Also ahead, we go live to Abu Dhabi to speak with former U.S. Assistant Secretary of State for Energy Resources, Amos Hochstein, about how to feed power-hungry AI. Our top story today, commodities on the move, oil prices rising after OPEC Plus agreed to pause output increases during the first half of 2026. That will follow a planned modest hike next month, with key members agreeing to revive 137,000 barrels a day. The decision to pause early next year comes amid a period of uncertainty for oil traders as they weigh sanctions on OPEC Plus member Russia and signs of ballooning glut. On the other hand, spot gold is under pressure after China ended a long-standing tax rebate for some retailers. It is a potential setback for consumers in one of the world's top bullion markets. For more on the market action, let's bring in Bloomberg MLive Executive Editor Mark Cudmore and Stephen Stepczynski, who leads our Asia energy coverage. Stephen, let's start with you. Oil up for a fourth day, but you know what? It is against a backdrop of a glut.
It is indeed. And I think the output or the reaction from OPEC Plus over the weekend kind of spells where the market is at the moment. You know, they did increase output for December, 137,000 barrels a day, but they did also increase to a pause for a whole quarter, which I think was surprising to some folks. And I was speaking with an oil trader over the weekend. He was expecting that perhaps we were going to be seeing a pause from OPEC Plus. So this was anticipated by the market. But the reason was interesting. He was looking at Russia. Russia is a key member of OPEC Plus. And because of the new sanctions from the Trump administration against Lukoil as well as Rosneft, their two biggest producers, that would make it more difficult for them to market their oil supplies. So increasing output from Russia would be challenging. They've been pushing for more moderation from OPEC Plus as well as higher prices. There are other ways to read this decision as well. You know, yes, we are facing a glut, so maybe this is OPEC Plus coming to the decision that, hey, if we add more barrels to the market will not be able to absorb it. One interesting thing for most of this year has been OPEC Plus increasing supply from April or so, and China, surprisingly, being able to absorb it because they've been stockpiling. But again, you know, you speak to the traders, speak to people in the market, China is starting to taper that. Their inventories are full. They finished doing that. So you go into 2026, they're unable to do it. How do you take those extra barrels? That's another way to read it, I think. And you're kind of facing the situation where OPEC Plus, as well as potentially American producers as well in the shale basins, deciding how to proceed from here as you're getting into a frothier year that could push prices lower.
So a lot of factors. WTI at, 65, 62, Brent around the same level as well. You say, Mark, meh, you know what? I don't really care.
Yeah, I'm afraid so. Look, ultimately, as we talked about last week, AI is driving everything in markets. And how do I look at the commodity markets through the AI lens? I think there's a couple of things. I think, first of all, US growth at the moment is holding up because of CapEx spending in AI, and that's feeding through the whole economy. And that means that superficially we've got a good enough growth level, but the real economy underneath is definitely struggling. Now, at some point, that bifurcation can continue. So that's kind of one of the longer-term negatives in oil. I'm not, Stephen's the expert in commodity markets and all the short-term drivers, but I think think the bigger backdrop into next year is that is going to weigh on oil, which is why OPEC Plus knows that there's going to be a supply cut. The demand is just not a great story. Now, on the flip side, on the AI story, of course, the big kind of derivative play on AI is, of course, energy. But that is increasingly moving towards the acceleration we're seeing on the clean energy future. And I know much longer term, many countries are starting to embrace more of a nuclear outlook. So I think that
oil prices matter for countries, for markets like India, for instance, right? I mean, it goes up and down according to where oil prices are. So it does matter to some countries.
I'm not trying to dismiss the oil excitement. I just think that OPEC Plus's decision wasn't so much of a shock. I don't think that's going to be the big driver at the moment. I trust Stephen and all the short-term drivers and all some of the dynamics around Russia. But in the longer-term story is that despite the energy story that I bring everything back to AI, the pressure on oil will remain into next year, and I think we'll see lower oil prices.
But I do think the AI story is interesting from an energy standpoint because you're not seeing it play as much into oil, but you're seeing it play into other markets. You mentioned renewables as well as natural gas. I think there's one thing to take a look at. If you're going to be looking at this market, it's Henry Hub. It's a U.S. natural gas benchmark, and more of these AI data centers are being powered by Henry Hub. They're being powered by gas. And so as you see more gas consumption increase, as you see the U.S. export more liquefied natural gas to its allies, or even to China perhaps if they come to some sort of agreement there, you're going to really see a lot of upward pressure on that and less so on oil. And what's interesting is that is also a key driver of inflation because that affects electricity prices for everybody. So I think that's one thing to also keep in mind.
The other question is, how low can oil go? Some are saying that given the glut, and you talked about how, AI will be powered by green energy, they see oil prices at mid-35 by next year.
Yeah, I think, when you talk to traders, when you talk to people in the market, clearly there is going to be a further falling. I think Brent into the $50 level is what a lot of people are expecting as the glut materializes and as you see that kind of happen. But are we going to see COVID level, prices? No, we're not going to go negative. We're not going to go into the 20s at $30 levels. I don't think that's expected exactly. I think there will be an appropriate market reaction. Either shale drillers pull back their output. I think that's really important going forward because while we've fallen into the $60 and now close to the $50 level for WTI, the shale drillers are still producing. They're still increasing their output, hitting new records as we speak, which is really fascinating. You would think that they would have pulled back, but they've been so good at pulling down their costs and being much more efficient while they use their rigs. You haven't seen that pullback. I think once we start to go down, maybe another $10 for WTI, analysts, I wouldn't be surprised, would expect that you would see that U.S. production fall down and then the market stabilize a little bit. So you don't see a total collapse in Brent and WTI.
So that's oil. Gold, sub 40, sub 4,000. I mean, that's saying a lot about the risk factor.
I think gold is a completely different story in terms of that. I think the gold, again, I'll trust Stephen on some of the short-term dynamics of this latest news out of China, but I think that, this is very marginal. That the underlying drivers of gold are the fact that the US is at the forefront of a developed economy debt problem. And longer term, over the years and decades ahead, the only political way to escape that is to essentially inflate away their debt, is to monetize their debt. They're never, ever going to cut the spending that's necessary, and they're not going to default as in their own currency. So essentially, everyone is aware the longer-term dynamic is a monetization of fiat currencies. What we just debate is how quickly it happens. If you're like a gold bug or a Bitcoinista, you basically think it's going to happen really, really quickly, and basically all fiat currencies are going to become worthless. I'm more in the camp that it's going to slowly become devalued over time. We're going to be in a long-term, higher inflation world, and that is supportive for what are perceived stores of value. I use the word perceived because I'm not convinced that actually gold or even more so Bitcoin are the best alternatives. But I think that's the backdrop story, is that over the coming years, people are going to keep on piling back into these things in the dips. They do not decide the short-term dynamics, and they do not mean that gold can't have a major collapse short-term collapse when we have a market disruption. Remember, every single time we have a big market disruption, gold always gets destroyed in the short term. You saw it in GFC, you saw it in COVID. You always see gold pull back, and you can go through brief deflationary panics as well, even though they will not sustain. So the longer-term story is very bullish for gold. I think this is why central banks are moving into it. They've been doing the structural drivers. Short-term, I just think that this correction is kind of set to continue lower, and I just think this news story hits the news flow that, hey, we got too over, bought in gold. Where does it pull back to? I don't know, but given how far it's risen, it could be quite a painful pullback, but it does not destroy the underlying story.
A steep correction, and a lot depends on China as well.
I mean, it certainly does depend on China. I mean, I think the Chinese retail buying, while important, isn't key here at all. But I think, again, going back to what energy traders tell me, never before in my over a decade of covering this have so many energy traders told me that they're in their own personal portfolio they have gold, and yet they're doing this as a hedge. To the risks. So just looking at the retail excitement from the people that I talk to globally, I think that they don't care so much about a fall below 4,000 because they bought when it was below 3,000. And they're still piling in. So they see this as an opportunity to buy. Will that move the needle enough to stop this decrease in prices? I'm not so sure, but I think overall the fact that this is becoming more and more of a mainstay of portfolios, both people who are just investing on the side versus professional portfolios, will remain higher for longer, and the long-term picture for gold might be more bullish.
Yeah,
I think one of the extra issues short-term, though, is, of course, that I'll kind of bow to Stephen on the short-term dynamics in commodities generally, but gold is very much a macro play. It's a liquidity play, and I think we're in an environment where the dollar is probably set to strengthen into year-end. We've probably got a little bit of move higher in US yields as well, and that dynamic means at the margin, given that the narrative around gold is short-term turned a little bit more negative, the underlying story is still very strong. That's why I think this correction can continue lower no matter what the news flow is.
And there's still people who think gold will get to 5,000. Bloomberg MLive executive editor Mark Cutmore and Stephen Sapczynski, who leads our Asia energy coverage. Now, still ahead this hour, we're heading to Hong Kong FinTech Week for an exclusive with Qiming Venture founding managing partner Duane Kuang on investing in China's tech space. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. The White House says China will effectively suspend the implementation of additional export controls on rare earth metals. A fact sheet issued by Washington also states that Beijing is terminating investigations targeting U.S. companies in the semiconductor supply chain. The developments follow last week's meeting between Presidents Trump and Xi in South Korea, which saw both leaders agreeing to a one-year trade truce. However, Trump said on Sunday that Nvidia's advanced Blackwell chip for artificial intelligence would not be available to other people. The comments aboard Air Force One came after questions had arisen over whether he would permit shipments of the advanced chips to China. So we see signs of some easing in U.S.-China tensions, but the peace looks fragile as disagreements over tech access still remain. Let's discuss what this means for investors with our next guest at the Hong Kong FinTech Week. Annabelle Drulis is covering the event for us. Belle.
Thanks, Haz. Yeah, we're joined here this morning by Qiming Venture Partners founding managing partner Duane Kuang joining us. So thanks very much for making the time. And Haz was just referencing there some of the tensions between the US and China, but of course you're a US dollar investor in the China landscape, so you're spending a lot of your time speaking with investors in the US, but around the world as well. What's the fundraising environment looking like right now?
Yeah, well, thanks for having me. The fundraising environment is warming up a bit compared to last year. We saw a fairly significant change around the so-called DeepSeek moment when the world is re-evaluating Chinese, especially technology assets. So the overall environment is slightly better than last year. The investors who are looking at financial returns and values primarily are coming back. The geopolitical aspects of it certainly has not changed that much.
With that in mind, we have been reporting at Bloomberg that you're raising right now, you've got a new fund in the works at a $600 billion valuation or size. That's down from maybe $800 million that was earlier reported. What's behind that drop, and how are you going so far as well in closing out this?
So I'm not going to go into the details, the specifics of it. I think the overall logic are twofold. A, we continue to see great opportunities in China. And we had a fairly substantial, significant size last fund. So we had a longer investment period than usual to deploy that larger size fund. And we are coming to the tail end of deploying that previous vintage. And given the opportunity, given the more challenging global investment environment, despite the warming up again since earlier this year, we felt it's probably best that we raise the right size fund and then quickly focus on investing rather than myself flying to every other continent in the world.
Duane, you talked about how the fundraising environment has improved just slightly. Why not more progress than that, given that the tech clampdown has eased and trade tensions within the U.S. and China have also eased? I mean, what more do you need to see before you think international investors would have more appetite to invest in Chinese startups, for instance?
That's a great question. I think the fundraising environment and the appetite for investing into Chinese technology companies have improved quite substantially from regions other than the U.S. So I travel to other parts of Asia quite a bit. I travel to the Middle East. I travel to Europe, and I also travel to the U.S. So if investors are looking at the potential returns of these great technology companies, investors looking at the valuation today and the potential for the future, then I think the answer is rather obvious. So in that part of the world, the investment sentiments and interest into Chinese tech has improved substantially. Now, in terms of U.S. investors, I think part of it still is that there are some longer-term questions that both sides are trying to resolve, answer. So I think the capital market has improved more. It is an asset category that you can come in and out a little bit easier than in the VC and PE market, where you are making a 7, 8, 10-year commitment. So I think with capital market doing better, we do expect and the improved relationship between the U.S. and China, we do expect the sentiment to also improve in the coming months for the venture capital investment as well.
Just to follow up on valuations, Duane, I'm just wondering why it's still pretty lackluster when it comes to valuations for Chinese tech. I mean, their valuations will be much higher if they were to fundraise in the U.S. Some say by 5 to 10 times more. What's your take on that?
There are multiple reasons for that. If we simply look at if we take AI as an example, if we look at the amount of capex that's been committed to the area, it is at least a 10-to-1 differential. And so in terms of capital deployment and capex investment, the environment is quite different. And then in terms of investor interest into startups, the companies in China, the first wave of AI deployment globally in the U.S. tend to be in the enterprise market, whereas China excels in the consumer space. So this is a space that's going to take a little longer for market education, for consumers to get excited about AI, get dependent on AI, and then eventually cannot live without AI. So that process is taking a bit longer than the coding co-pilots and other enterprise applications. So the U.S. AI B2B companies are having faster revenue traction the Chinese AI companies are coming in onto the stage and the level where revenue tractions will happen. It just lacks that of the U.S. a bit. So there should be, and it's reasonable to have some differential in the valuation, but certainly not a 10-to-1 difference between the size of the two economies, the potential of AI that would redefine how we live, work, and get our health care.
What's your then investment parameters? Because I look at some of your funds or the companies that are in your portfolio. There's Step Fund, for instance. There's Jibu AI or ZAI. But what made those companies stand out to you in particular? And what's your general thesis as well for how you choose amongst them?
You mentioned a couple of our AI investments. Those two are in the LLM space, the large language model space, the infrastructure space. And I think our investment approach is we try to move what we call half a step ahead of the market in identifying opportunities. So when infrastructure build-up, LLMs are still a scarcity, we would like to identify these companies that could excel when this particular area becomes an essential portion of part of AI. Now, we also feel that the battle for LLMs, for the model fights, I think the players are more or less at the table already. Who will ultimately emerge as the ultimate winner? Probably too early to tell. I certainly believe that our companies have a better than average shot in gaining that spot. So going forward, our focus are more on the AI applications. AI application in the humanoids and robotic space, AI application in the social space, in how we interact with AIs in the agentic space, and so on and so forth, and a lot of the toolings to make AI more affordable, easier to use. So those are things that are time dependent. It depends on what time frame we're looking at these opportunities.
It's interesting you mentioned sort of the industry behemoths and then versus sort of the incumbents, and one company you've invested in is Insta360. It's sort of seen as a GoPro competitor. They've also got a company within that, anti-gravity, that's recently started to build out its drone business as well, and this is sort of maybe going head-to-head in some ways with DJI. We hear that they're looking at fundraising right now. Are you looking at taking a stake in this business, and what would be the size of that stake, and at what sort of valuation?
We had a long history with Insta360. I think the theme and the success of Insta360 highlights a very important investment theme and category that we focus in, and that is Chinese companies, technologies, and product capabilities coming onto the world stage. They're no longer synonymous to better price for money, for values, and so on. They are leading their category. So we were happy to see Insta growing the way they grew. And when we heard the new effort in anti-gravity in this new area, we certainly are interested. So we are interested in that area as well.
Duane, it's been such a pleasure speaking with you this morning. That's Duane Kuang there, Qiming Venture Partners founding managing partner. Has back to you.
Belle, thank you so much for that. This is Bloomberg. Welcome back. You're watching Insight. FX investors are on watch for the Indian rupee to cross the 89 level to the dollar and notch a fresh record low. The rupee, one of several Asian currencies facing pressure after the dollar posted its second best month of the year in October. Fed Chair Jerome Powell's caution against counting on another rate cut in December, also adding support for the greenback. Let's discuss this with Bloomberg EM macro strategist Marcus Wong. You get a sense, Marcus, that the Indian rupee will test yet another record low.
Yeah, I mean, it's close to 0.1% away from that level. And I think it's fair to say that odds are favor that, the rupee potentially hitting that lows. I mean, if you look at the catalysts that has driven the rupee to these levels recently, for example, like for a hawkish repricing the Fed, or even stuff, in domestic catalysts such as, the RBI squaring off NDF positions, or even, importers demanding dollars once the rupee fell past 8 per dollar level. I mean, these are catalysts that could possibly extend in the near term. So it's fair to say that, we could see the rupee inch past that fresh record low levels. But that said, we saw RBI coming in last week in a small way, according to our reporters onshore. So we could possibly see the RBI continue to tinker the sights, pushing back mildly against further rupee weakness. But I guess the big question for investors out there is whether we'll see a larger intervention from the RBI, like what we saw on November 15, where we, resulted in the rupee rallying by 0.8% or so. I guess the big question for that is if the rupee, moves closer towards a 90 per dollar level, and this is a level that is keenly watched by investors as well as the central bank apparently. If that does happen, then we could possibly see the RBI coming in a bigger manner, and in a sense, investors are also on the sidelines expecting that could potentially happen if the rupee slides towards that key level.
Marcus, what is needed for a turnaround in the rupee, especially against a backdrop of a dollar that's now pretty resilient?
Yeah, I mean, as you correctly mentioned, it was Powell's cautious signaling at November's FOMC that has driven the dollar up. And it's not just the rupee, it's actually the larger Asian and larger EM complex that has been dragged down as a result. So what could possibly turn, of course, is if closer towards the December FOMC meeting, for whatever reason, investors start to price in a more dovish pivot in the Fed. I think markets are still pricing some odds of a rate cut, though of course it's much less of a certainty than compared to before the November FOMC meeting. Another catalyst that could see a meaningful turnaround in the rupee is if US and India sign a trade deal. Existingly, US imposes 50% tariffs on India goods, and there was some talk in maybe 2 weeks before or so that tariffs, a deal could be reached and tariffs could be lowered to 15 to 16% instead. So if there are signs that meaningful signs that a deal is going to be reached, we could see, of course, a meaningful turnaround in the rupee as a result.
Isn't it true, though, that we expect the dollar to remain resilient? And we had Powell pushing back on December, and some say that perhaps 3 is the new 2 in terms of CPI.
Well, I mean, that's a caution that was not signaled by not just by the Fed, by Fed Powell, but also all the quite a number of FOMC members since then, that they are signaling caution over inflation, that inflation has still continued to tick upwards, and the employment situation is probably not as bad as some would warrant a cut in December. So, it's all these deliberations and also the fact that we saw quite divisive voting at the November FOMC that has seen investors price in a more hawkish outlook for the Fed. But I would like to add that it's not just the Fed alone. There are other factors. For example, the dollar does not rise in isolation. If you look at, for example, the yen and the BOJ, it is increasing odds that the BOJ could hike in December, and that of course has weakened the yen, which has also pushed up the dollar. Also, other things that possibly that have changed the narrative is of course the Sell America theme. That was something that was very strong in April. When there was a strong chorus from globally that investors were going to relinquish US assets, but what we've seen so far is that's not been the case. Even stuff like hedging has not been suggesting that Sell America theme has been gaining traction as a result.
Right. Marcus, thank you. Bloomberg EM macro strategist Marcus Wong there. We'll get exclusive insights on the Indian rupee and equities later in the show from one of the country's biggest money managers. HDFC Asset Management CEO and MD Navneet Munot will be joining us in under an hour. Now, staying with the Fed, rate outlook, and Treasury Secretary Scott Bessent is calling for further rate cuts to boost the U.S. housing market.
If the Fed brings down mortgage rates, then they can end this housing recession. Low-end consumers who have gotten killed under President Biden these high rates are hurting them because they have debt, not assets. So I think that there are sections of the economy that could go into recession.
Let's get insights on how interest rate fluctuations may affect the U.S. real estate markets with Warren Wachsberger, his co-founder and CEO of Eldridge Acre Partners, a U.S. real estate investment firm which aims to invest around $3 billion over the next 5 years. Good to have you with us.
Great to be here.
So Basson says cut mortgage rates and you will end the housing recession in the U.S. Your thoughts?
Well, thanks for having me here, firstly. Right now in the U.S., it's about 66% more expensive to own than it is to rent. And so there's a lot of ways to go in terms of fixing the housing affordability issues in the U.S. What we're really focused on is how do you actually improve the amount of multifamily that's created, which will help bridge that gap in terms of giving housing availability to the U.S. consumer.
How much stress is there in the market right now?
Well, if you think about it like this, the mortgage rates are now at right around 6%, and so after rate shock, there's a significant amount of stress, and it's really been a result of no action. People are kind of staying still on the home ownership side, and so where we're sort of seeing that movement is from a demographic perspective, from the Gen Z and millennials who are moving towards creating households and household formation. Where are they going to live? You have 6 to 8 million Gen Z and millennials coming into that age of household formation. It's one of the largest cohorts in history. And as a result of that, you really need to figure out how are they going to afford housing and where are they going to be, especially because supply is about to fall off of a cliff in the U.S.
It wasn't too long ago that we were expecting aggressive rate cuts. Now, Powell is pushing back on a cut in December. How are interest rates and assumptions to do with interest rates shaping the thinking, not just in the retail, market, but also in terms of the commercial real estate?
From an institutional perspective, really the 10-year is the discount rate that we're looking at. And if you saw post-Powell's announcement, the 10-year was up. And so we still had a cut. 10-year goes up, which has been happening. And that's really a result of future market expectations, inflation, and the fiscal policy in the U.S. Right? The U.S. is running deficits at 6 to 7% of GDP, and so the market's looking at that and looking at the 10-year and saying, well, maybe we actually do need to increase given what's going on. And so because the 10-year is sort of our measure of return and what we use as the discount rate, that increased 10-year has really reduced supply significantly. So if you look at what's going on right now, just in terms of housing supply, right, our biggest source of housing is going to be the multifamily space. That housing has gone down dramatically. So I think we had a peak of 1 million units in 2023. That has gone down 25 to 30% over the last 2 years. And we're seeing a place in 2026 where multifamily creation is going to be below 1% of inventory. And so it's typical for these cycles that you see where when housing falls at that level, you start to see demand, which is going to increase, as we spoke about, in terms of the demographic trends. And so as a result, you're really going to see pressure on rental rates and housing costs because of the fact that there's no supply. That's a bad thing for the market, but there's also an opportunity to invest to take advantage of that.
Where are the opportunities you see?
Well, we in particular see that opportunity in housing because of those tailwinds that we'd spoken about. Those large demographic trends, specifically around the millennials and Gen Zs, what's going on in terms of supply. So supply is falling off of a cliff. You're in a situation now where you can't adjust for 2 to 3 years because it takes a long time to build. And so from our perspective, you should be building when no one else is. And so for us right now, investing through structure and being in a position where we can take advantage of this supply falling off of a cliff, we think will position us well when that does occur to be able to meet that demand, which is surely coming online.
You talk about supply falling off a cliff. That would have a lot of implications on cost, on the prices. What assumptions are you making in the next 12, 24 months?
So we're already seeing it. I was on Bloomberg, I think in March of last year when tariffs were first announced, and our view was that tariffs actually would not have too big of an impact on pricing. That's held true to today. If you look at the sort of the key inputs in building in the U.S., you're looking at soft lumber, aluminum, steel. Those are the places where tariffs were most hit. And when you actually run that through the cost of a construction project, we only saw between 2 to 4% increase in cost as a result of tariffs, which is relatively small. Part of the reason is because there's just not as much pass through, but part of the reason is because no one's building, and so you're seeing a lot of competition. So historically, maybe you saw general contractors pricing 3 to 4% GC fees. Now that's going sub 3% because people are hungry for work, and that's going to set us up for that supply kind of cliff that we've been talking about.
New York, of course, a very important market, and all eyes on the housing market there. How closely are you watching the mayoral race and how that might have an impact on the property sector there?
I think it's good to be a South Florida realtor right now. Listen, I think putting constrictive policies on housing is the worst thing you can do to make housing affordable. You want to encourage more development, less restrictions, and so if the city goes that route and makes it easier to build, then we're going to see housing prices come down, and we're going to see a real renaissance in terms of New York City. If they make it harder to build, they start punishing developers and so forth, putting in rent freezes and things like that, you're going to see housing affordability actually become worse.
Let's talk about investment flows. I'm curious, it's not just about the rate cycle, it's also about tariffs and the trade war. How's the appetite like when it comes to international investors? What's their appetite for exposure in U.S. assets?
So I can talk specifically around the U.S. real estate assets. I spend a lot of my time talking to investors and really trying to gauge kind of their interest in the U.S. real estate market. And people fall into two camps that are somewhat diverging. The first camp is people who are working at, let's say, a government pension fund who's maybe facing some sort of retaliatory tariffs from the U.S., is feeling a lot of pressure not to invest in the U.S. right now. And so they're figuring out how they get exposure to the world's biggest market. And then other investors globally are saying, we see that lack of capital going in, and so now is this an opportunity for us to enter that market and perhaps get better terms associated with our investments. And
so you don't see a reallocation. I mean, other markets like the UK, Australia, Japan even are very interesting markets, and a lot of investor interests are in those markets. Could that be an outflow from the U.S. into the other markets?
I think in certain circumstances that's happening. I think people are more waiting and seeing in terms of what they're doing. There's a lot of inactivity, primarily because the return of capital hasn't come from private equity and investments in real estate, where people had invested, they haven't gotten capital back, and so they've got less precious capital to allocate, and so they're sitting on the sidelines determining where's the optimal place. Again, the U.S. is still the biggest market in the world, and so it's hard to avoid the U.S., but there's certainly conversations we're having where people are being told by their investment committees to pause U.S. investments.
In the end, it is about returns, it's about yield. What's realistic?
Well, I think the biggest thing is in terms of the yield per dollar of risk that you're taking. And so what we're seeing now is that for every dollar of risk you're taking, you're needed higher returns. So even if you're investing in core, you still need higher returns in order to compensate you, just given where that risk-free rate has moved. So we'd spoken a little bit earlier about how the fact that we view the 10-year as sort of our benchmark discount rate. Well, when the 10-year is at 0% and we've got effectively free money in the U.S., your rates of return are obviously a lot lower. Now we're sitting in a situation where you're sort of range bound on the 10-year between 4 and 5%. So those return expectations go up, and it's changing that allocation perhaps to maybe strategies that didn't qualify previously, whether it's value add or opportunistic real estate, that investors around the world are starting to take a closer look at again because of the fact that they need higher returns in order to compensate themselves.
How are you looking at the environment right now, and how are you deciding when, the government is under shutdown, there's no clarity on data? What assumptions are you making about, the Fed moves, which are essentially an important part to your investment decisions?
And the good news is there's still a ton of private market data out there that people are able to rely on, and that private market data is still being generated. It's certainly interesting that Powell did lead his comments at the last Fed meeting with the fact that you should not expect a rate cut in December. I think it went from 92 to 63% in terms of percentages of rate cut. I think it's come back a little bit now, and so as a result of that, it's really determining what does that long-term view look like? Because if you're worrying about those short-term rate movements, you kind of get into analysis paralysis. For us, the long-term movement is we look at the long-term structural trends, what's going to happen. The U.S. is still going to create new households. They're still going to need people to where they're going to need to live. And so as a result, our focus is on that housing sector without having to worry about sort of those short-term rate movements.
And the biggest bet you're making and the risk to that would be?
I mean, the biggest bet we're making, the biggest risk is that liquidity floods the market. Because right now what we're seeing is that there's not a lot of liquidity in the market. That's enabling us to come in with structured capital in situations that maybe 3 or 4 years ago weren't available to us. That structured capital is giving us downside protection with equity-like upsides. But were there to be significant liquidity flowing into the system, those opportunities may not exist, and therefore the alpha goes away. So for us, we kind of like the fact that people are sitting on the sidelines.
Warren, thank you so much for that. Warren Wachsberger of Eldridge, Acre Partners. Still to come on Insight, U.S. and UK authorities accused the China-born chairman of Cambodian conglomerate Prince Holding Group of operating a transnational criminal network. More details ahead. Keep it here with us. This is Bloomberg. Welcome back to Insight. U.S. and UK authorities are accusing the chairman of Cambodian conglomerate Prince Holding Group of running a transnational criminal ring. Chen Zhi allegedly used forced labor to run scam centers and laundered billions of dollars in stolen funds. Let's bring in Bloomberg Asia investing reporter David Rumley. Talk to us about Chen Zhi. I mean, what do we know about him? I know he's young. He's all of 37 years old, and he's managed to do this.
Yeah, it's hard to say exactly what his background was, but what we do know is that he is allegedly one of the biggest transnational crime ring leaders in the world. The amount of crypto seized from him alone was $15 billion. So we can only start to estimate what other businesses that he got into, be it online scam rings, again allegedly, casino groups, etc., could be worth. He also had properties all over the world, from London to Singapore, Hong Kong, Taiwan. This is a guy who, we understand, originally came from Fujian in China and eventually emigrated to Cambodia pretty early, around the early 2000s, and started building up a property empire there and building up businesses there. From there, he built up more conglomerates, and then eventually, circa 2018, established a family office here in Singapore.
You got to ask the question how it's even possible. We talk about how it is a global scam, right? It involves London, Singapore. You'd imagine, I don't know, they would do due diligence. How has he managed to escape?
Money. Huge amounts of money. He's been able to bankroll a large number of companies, entities, listed companies in certain markets, private companies in others. He's amassed huge amounts of assets. And just by using the legitimate... Remember, until 2025, this year, until very recently, nobody had sanctioned him or any of his vehicles. So he was able to use the Singaporean, the Hong Kong, the global banking network to transfer funds around the world. Now, Singapore has recently said, only just late last week, late on Friday, that there were some suspicious transaction reports that were filed by certain banks, and that some banks and institutions took some measures to limit how much he could hold in Singapore. But from what we've seen, they also say that they've seized over 150 million Singapore dollars in assets. So clearly the limitations were not too onerous. He was able to amass a very large portfolio of properties and companies here in the city-state. So you multiply that across London, Taipei, Hong Kong, Palau even, where he had numerous businesses, casino groups, etc.
What is Singapore doing about it?
Well,
and what are the implications on the city, which is known to have zero tolerance for scams and corruption?
I think we'll still need to see if there are any consequences. This is the latest in a series of cases that have really rocked the city-state, right? We only just recently saw the somewhat conclusion of a $3 billion money laundering ring, where a bunch of different people were brought down and sentenced to various terms in custody. So whether or not this is a further tarnishing of the city-state's reputation for being clean is yet to be seen. We need to see the full scope of this play out. And again, this is an allegation. But what we do know is that he had extensive ties in Singapore. And as recently as 2024, last year, there was a very interesting series of reports by Radio Free Asia, which really detailed Prince Group, Chen Zhi, and his extensive holdings and the allegations against him. And yet that same year, after those reports came out, Ascot, which is a subsidiary of Capital Land, signed a huge deal with them to manage 2 properties. After the US and UK authorities announced that they were sanctioning this man and his entities, you could still go onto the Ascot website, book a hotel room that they managed that was owned by Chen Zhi, Prince Holding, and Canopy. So that shows the level of ties that went into this man's empire and Singapore.
What's been really interesting is that despite the amount of money that he has, he kept a really low profile.
That's right.
Isn't that true?
Absolutely. This is a guy who, 2017 alone, he buys more than $50 million worth of Sing dollars of property in Singapore. And he lived quite an elaborate life. We understand that he drove around in black-colored Maybachs, always with the license plate 5555. Seems to be a leitmotif in his life. Always in Alphards or Maybachs. Very sensible person. Unlike some other cases, he was more low-key, from our understanding, much more reserved, and not someone who was super flashy. But he's still using this very quiet, steady method, built up a family office here, built up many entities in Singapore. He even had a 54-meter yacht that was parked here called the Nonny 2, which was only recently sold, to our understanding.
Do we know where he is?
No. Is the long and short of it. He is, as the U.S. authorities would say, at large, but that doesn't necessarily mean he's on the run, per se. We suspect it might be Cambodia.
David, great stuff, fascinating. Bloomberg Asia investing reporter David Rumley there for us. Now here's a look at our guests coming up in the next hour. We'll talk oil prices with Vanda Insights founder Vandana. The CEO of HDFC Asset Management will also be joining us live for his outlook on Indian markets. Plus, we're live at the ADIPEC conference in Abu Dhabi with TWG Global Managing Partner Amos Hochstein. More to come in our next hour of insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight with Haslinda Amin. We're tracking gold today with prices dipping below $4,000 after China scrapped its long-standing gold tax incentive. It's a potential setback for consumers in one of the world's top bullion markets. Let's get more from Bloomberg Asia Energy and Commodities editor Andrew Janes. As much as we talk about how gold is below $4,000, it's still up 50% year to date.
Yeah, that's right. So what happened was gold retailers will now be unable to get a rebate that they were previously able to get. And we've seen a dip of about, I think, as much as 1% this morning in gold prices. China is, of course, the biggest gold buying nation. We've actually seen a bigger dip in Hong Kong jewellery shares. I think Chow Tai Fook was down as much as 12% at one point. So the thinking is it's really going to hit jewellery demand. And I guess, obviously, we had that really blistering run-up in gold, which stopped about 2 weeks ago. I think we've come down maybe about 10% from the high. I guess this is another reason for gold to perhaps consolidate for a while. Of course, we've had the US-China trade detente, which has been the main reason, and just the fact that that rally was so overheated and the gains were so spectacular, we've come back a bit. And this is another factor that should help that.
What's the market expecting in terms of how deep this correction might be?
Not too much deeper, I would say. I think we're down about 10%. I think the general consensus is it could deepen a little bit, but we wouldn't expect it to go down significantly by several $100 an ounce from here. Many of the factors that drove gold higher are still in place. I mean, we still have a huge amount of trade and geopolitical uncertainty. We still have the so-called debasement trade, where investors are worried about budget deficits and
we have central banks buying more and more gold. I'm sure that will perhaps provide that support.
That's true.
To gold prices.
Yeah, I mean the support is still there. If you're talking about risks to the rally, why it might not keep rising, I guess the big thing is Fed independence. Worries about Fed independence have been a major factor in helping drive prices up. If that, in fact, turned out to be not the case and the Fed managed to maintain independence, that could see gold going down. If central banks, their buying slowed, that could see gold down, and if the dollar route reversed, that could see gold going down. But the consensus is after a period of consolidation, gold prices are likely to rise again.
In terms of demand, is there any clarity on demand from the likes of China and India? Both are the two major countries, major buyers of gold.
Well, in India, we've still seen demand for jewellery stay very strong, despite the fact that prices have gone up. And of course, gold and jewellery has a sort of a big cultural cachet in India. In China, which is the world's biggest gold buyer, I think it's just going to be economy dependent and will depend on what happens to sort of headline GDP numbers.
All right, Andrew, thank you so much for that. Bloomberg Asia Energy and Commodities Editor Andrew Janes there. Now we're continuing to track movements in oil after OPEC Plus agreed to pause output increases during the first quarter of 2026. That will follow a planned modest hike next month, with key members agreeing to revive 137,000 barrels a day. The decision to pause early next year comes amid a period of uncertainty for oil traders as they weigh sanctions on OPEC Plus member Russia and signs of a ballooning gut. Let's get perspective on the energy markets with Vandana, who has about 3 decades of experience providing intelligence on the sector. She's the founder of Vanda Insights. Vandana, good to have you with us. Your thoughts on where oil prices are today?
Good afternoon, Haslinda. So it looks like Brent has been locked into a holding pattern around $65 a barrel. The sort of opposing pulls, if you will, on prices right now. One is, of course, what you just alluded to, the glut narrative. Look, we are probably in an oversupply situation, but how much oversupply? I think the jury is still out on that. And on the flip side, you have a supply risk premium, which has come back in a major way into the market after the US and EU sanctions on Russia a couple of weeks ago. So those two forces seem to be a bit balanced for Brent around 65, which is why I think the holding pattern is what you're probably going to see for the foreseeable future.
So never mind all the factors in play at this point in time, given that there is a glut that would put a limit to how high oil prices can go, even though it's risen for the last 4 days.
Yeah, Haslinda, I would hesitate to call it a glut. I know that word has become very, very common in the market. A lot of people using it. It is nuanced, Haslinda. It's if you're talking about a seasonal excess, which absolutely expected, and I'm with it, of let's call it a 1 to 1.5 million barrels per day, which we do see in through Q4 and Q1 historically. But is it anywhere from 4 to 5 million barrels per day on the other extreme, as some analysts are calling for? I don't think so. So is it actually a glut, or is it just a seasonal excess that we're seeing in the market? I think that debate needs to be decided one way or another before we see prices moving decisively higher or lower from the current levels. But in general, Haslinda, yes, I would say that the path of least resistance is probably downward for now, because the $65 anchor is really hinging on the market still waiting to see how much of Russian supply is disrupted. My base case is that the market will find workarounds around the U.S. sanctions on Rosneft and Lukoil. We already see India and China are turning cautious, the refiners, in terms of purchases of Russian oil, but nobody has fully halted Russian oil purchases. So perhaps path of least resistance is down, but that risk premium element needs to be decided.
Vandana, is there any clarity how much Russia actually produces? There's no official number out there.
No, we stopped getting any official data from Russia pretty much in 2020, starting in 2022, even when the market tried to assess what would be the impact of the U.S. blanket ban on Rosneft and Lukoil, the two largest Russian oil producers. The estimates and what do they produce and what do they export, the estimates are in a wide range of anywhere between 40 to 60% of Russian oil exports are accounted for by these two companies. What we do know, Haslinda, actually is quite a lot of good, transparent, credible data in terms of seaborne shipments, which is the vast majority of Russian crude and refined product exports. So I would put that number at around 6.5 to 6.6 million barrels per day. About 4.2 million barrels per day, give or take, is Russian crude condensate exports, and about 2.2 million barrels per day is refined product exports.
You talked about how you're reluctant to call it a glut in the market. I'm just wondering how you're looking at, the impact from U.S. production. Currently at a record, they say, despite the fact that, the market has enough oil to last a long time. How is that squaring off?
So the proof of the pudding, Haslinda, is in the physical market. You will see very, very clear signs emerging if there's more barrels than buyers looking to buy. You will see prices go into in the futures market go into a contango. Now, while we have seen that contango approaching towards the front of the crude curve, the next 2, 3, 4 months of crude prices, when you look at Brent and WTI futures, remain in backwardation, which is associated with roughly balanced markets. You would see physical spot barrels going into discount rather than premium. Now, what we are seeing is a narrowing of the premiums, but they're not flipping into a discount. The couple of metrics that the market has fixated on is oil at sea, how much oil is sitting on water in tankers or in transit from producing countries to buyers. And while those numbers have indeed swollen, and some of them have been in recent weeks as high as what we last saw in 2020, it is a noisy data. So again, which is why I go back to the jury being out on how much of excess do we actually have. It's noisy data, Haslinda, because the Russian barrels, and especially because of the latest sanctions, are taking longer to reach the ports of the buyer countries. And then there's, of course, sanctioned Venezuelan and Iranian barrels as well, which are, taking circuitous routes, longer voyages, more ship-to-ship transfers, which all amounts to oil sitting on water for longer than what we would have usually seen. So, which is why quite a murky picture there, no clear signals.
Vandana, as we speak, we have Morgan Stanley revising up its projection for Brent crude. In fact, it says that for the first quarter, it expects Brent crude to rise $2.50 to 60 barrels a day. Even that estimate is pretty muted, don't you think?
Yeah, it's quite muted. I would be very surprised, Haslinda, at this point to see any of the plethora of downward revisions in prices that analysts have done for 2026 to be revised upward. I don't know what the reason for Morgan Stanley's revision is. I haven't seen the report. But if it's the OPEC plus pause again, I expect that to have minimal impact. It is a sort of I think OPEC plus G8 being cautious. They're not actually pulling back any barrels from the market, just calling it a freeze for Q1. Quite counterintuitively, some in the market might think that endorses tacitly the view that there is perhaps a glut. So no, I think in general, Haslinda, for 2026, as demand growth continues to decelerate globally, definitely my base case, and plentiful of oil supply in the market, I would expect prices to average lower, perhaps $4 to $5 lower than this year.
Yet some people are saying that oil prices to get to 35 by next year. I mean, why so much discrepancy in the estimates of oil prices?
I think partly it's because it's really difficult at this point to, first of all, assign a risk premium going into 2026. While definitely Russian disruption is the norm for now and for, let's call it, the next 2-3 months, it's entirely likely that the situation flips around by 180 degrees. You know, let's say Putin makes overtures and they get back to the negotiating table over the Ukraine war, and then you see the US not enforcing its latest sanctions, same for EU, or maybe even starting to pull back the various stages of sanctions. So very hard to call it one way or another. And the other major sort of uncertainty on the demand side is what happens to the tariffs and the trade wars. We have seen quite a bit of thaw in US-China trade tensions recently. Does that continue in a positive direction, leading to a little bit of a better economic growth in China, likewise in the US, likewise in the rest of the world, which would then mean a little more positivity for global oil demand growth than what we are currently assuming. So those two major factors on the supply and demand side remain in flux, remain quite hazy, which perhaps explains the sort of range of estimates that we are seeing for prices and demand-supply balances in 2026.
I just want to put it out there that some people say that even with the truce within the U.S. and China, it doesn't change the math for oil prices going forward, at least in the next 12, 24 months. What assumptions are you making about China's demand, given the data we're getting right now?
I think overall the market has probably gotten used to being skeptical or even cynical with regard to US and China actually getting back on track with their trade ties. We have seen quite sluggish Chinese economic growth pointers from data, the latest data the last few days being the China manufacturing PMI, which has slipped, not only slipped into negative, but also quite low, major slump in October compared with September. So that has disappointed quite a few in the market. I think overall the market, as far as the oil demand is concerned, will remain very, very cautious with regard to Chinese demand. The big imponderable on the part of China really is how much it continues to buy for stockpiling. That has been the main contributor from China in terms of oil demand this year. But again, there's a lot of question marks there. China's been buying close to 900,000, 1 million barrels per day simply to put that crude into stockpiles. At what pace will it continue to do that? And if that pace drops, we could see much more surplus emerging in the markets.
There seems to be a pivot in how people are looking at the U.S. dollar. I mean, it used to be a case of, that debasement theory, and now we're seeing the resilience in the USD. How is that impacting demand for oil?
Not much, Haslinda. So it is one of the factors, the correlation or the negative correlation that we see conventionally. And again, I would stress here sort of the rule of thumb that they are negatively correlated, crude prices and US dollar. But that correlation has been broken for quite some time now. So I don't expect the US dollar, and it remains quite in fluctuation based on what the Fed is doing or is expected to do, but it's not overall not really having much of an impact on crude prices.
So what themes will be playing out in the oil market in the next 12, 24 months? What should we be looking out for?
So definitely, where do we go from here with regard to Russia sanctions? I would be looking at very, very keenly for any signals from the Kremlin that they are perhaps willing to compromise, come to the negotiating table. At the same time, keep a close eye on Kiev's continued, sustained, stepped-up attacks on Russian infrastructure, especially on export ports and terminals. I think that is a big deal because that can disrupt Russian exports in addition to the U.S. sanctions. And I think OPEC Plus is pretty much steady as she goes. I don't see any surprises there. And on the demand side, of course, keep an eye on what happens with the trade deal, not just between the U.S. and China, but U.S. and India. Remember, we were almost on the edge of our seats a couple of weeks ago on news that there may be a trade deal between these two countries. That is yet to come. That might support demand sentiment a little bit as well.
Vandana, thank you so much for that. Vandana Hari, founder of Vanda Insights. We thank you so much for your time today. We'll get more insights on energy later this hour. TWG Global Managing Partner Amos Hochstein will be joining us live from the ADIPAC conference in Abu Dhabi. And up next, hear exclusive insights from Hong Kong Exchange CEO Bonnie Chan on the outlook for IPO listings in Hong Kong. Keep it here with us. This is Bloomberg. Welcome back to Inside. Hong Kong Exchange CEO Bonnie Chan says she's optimistic about the city's IPO pipeline and the continued return of international investors. Chan spoke exclusively to Bloomberg about the outlook.
So far, I think, the momentum has been great, and we are now at over 80 completed IPOs, and we're in early November, so let's see what number we can wrap up the year with.
That's a lot of gong ceremonies, obviously, this year, Bonnie, for you. But when it comes to, once we get another, wave of these IPOs, again, we're talking about 300 in the pipeline. Are you concerned that a big chunk of that money is going to be taken away from the equity market?
Sorry?
Are you concerned that the liquidity issue, that there's going to be a big chunk of money that's being taken away from the equity market?
I see. Not at all. In fact, what is really pleasing this year, it's a return of international investors. So if I look at the IPOs which have been done to date, many deals we are seeing over half, and in fact some deals are even close to the 70-80% mark, representing international investors returning to the Hong Kong IPO market in earnest. So so long, I'm personally very confident that so long as we're able to present investors around the world with the right opportunities, the money will come.
Yeah, I just came back from South Korea. You just came back from Saudi, so certainly we have a lot of takeaways from both these trips. But the fact that the U.S. and China have reached a truce for 1 year, what does that mean for Hong Kong in terms of the outlook now?
Yeah. Well, I think if you dial the clock back 3 weeks ago, people were actually worried that maybe the leaders are not going to meet at all, which obviously turned out to be not the case. And I guess, what I focus on at HKEX is really to make sure that regardless of market conditions and, these trade talks and, the geopolitical situation, we provide the investors around the world with a resilient market, an orderly market that they can trade in and out. I think, with the talks continuing, it's a truce for now, like you said, things will pick up again. Hopefully, we continue to have that, very trusted market so that regardless of how investors want to take their position, they can trade.
I think at the height of things when we're quite tense, there was this threat of Chinese companies being delisted in the U.S., and maybe people were hoping that Hong Kong would be that place that they could seek some refuge and the like. There was a bit of pressure earlier on this year about easing these so-called dual-class shares, and that the need to kind of prioritize that. Is there less of a need and urgency now, given now that we're in a truce?
Well, I think the way you put it, the focus seems to be on the push factor, right? Because, companies are worried about delisting risk. I tend to focus on the pull factors, the attraction that Hong Kong is capable of providing, which is, first of all, right, the access to global capital. But more importantly, and that's our secret weapon, as you know, is the Connect franchise, whereby companies listed on our exchange is capable to tap the very strong southbound flow of capital from the Chinese mainland. That sets us apart from other exchanges. So I think, and you have seen, obviously, the southbound volume since the beginning of the year has stayed very, very strong. And so I would say that, regardless of the geopolitical situation and whether or not these threats are real or not, I do trust that, the Hong Kong is able to present a set of pull factors whereby companies will really see the merit of getting a listing on the Hong Kong market.
And that was Hong Kong Exchange CEO Bonnie Chan speaking to our very own Yvonne Mann at the Women Chief Executive Summit underway in Hong Kong. Now to some of the top corporate stories we are following. Berkshire Hathaway's cash pile surged to a record $382 billion in the latest quarter as earnings also jumped at Warren Buffett's conglomerate. The firm's cash hoard grew as Buffett avoided deals during the quarter. Insurance underwriting profit more than tripled. Berkshire declined to buy back shares for a fifth straight quarter. The stock has tumbled almost 12% since Buffett said in May he would step down. Australian lender Westpac reported profit in line with estimates thanks to growth in mortgages and loans to businesses. CEO Anthony Miller has worked to overhaul the lender since taking over in December, reshuffling senior management and cutting jobs to reduce costs. Westpac also sold its Rams mortgage portfolio to a group, including KKR, a move Miller says further simplifies the bank. Taking a look at trading here in Asia. Asia is in positive territory. The MSCI HKEX index up by 0.5%, of course, on the back of easing tensions between the U.S. and China. China suspending curbs on rare earth metals. Coming up, we shift our focus to Indian markets. As the rupee nears a fresh record low, we'll get exclusive insights next from HDFC Asset Management CEO Navneet Munot. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Here's a check on Indian markets nearly an hour after the open. Here's how it's looking for the Nifty and the Sensex, both in positive territory, but barely. The Sensex up about 0.1%. In terms of the Indian rupee, 88.78 is the level we're looking at, pretty flat versus the USD. Of course, this is one currency that's been in focus near a fresh record low. Its previous record low was 88.8050. That was clocked on September 30th. So keep an eye on that currency. Our next guest runs one of India's largest and most prominent mutual fund houses. Joining us exclusively, Navneet Munot, MD and CEO of HDFC Asset Management with more than $100 billion in assets. Navneet, good to have you with us. I just want to take stock of the Indian market. No blockbuster returns so far, only 8% when it comes to the Nifty. And when it comes to mid-caps, it's only 3% year to date. What's going on there?
Good to be with you this morning, Haslinda. And I think this seems to be a year of consolidation. Indian markets did very well for a couple of years post-COVID. And we have seen a moderation in corporate earnings growth, and it's also reflecting in the overall market returns. But I think the policy has been reflationary. Government of India has done cut in GST as well as in personal income tax, putting more money in the pockets of people, should revive consumption, and the Reserve Bank of India has been cutting interest rates and releasing liquidity. So overall, I expect earnings growth momentum to pick up and Indian markets over a period to do well.
Navneet, is the froth gone from the Indian markets? Not too long ago, we were talking about how high Indian valuations were. Despite, the correction, it was still very expensive. Is the froth gone now? Is it time to get your, to dip your toes in the Indian market?
I think relative to emerging markets, the valuation premium has come down. Relative to history, where the valuations were, I think they have eased over the last 1 year. Since there has been a time correction, market has been consolidating. And as I said, that over the next couple of years, the earnings momentum should pick up. And looking at that, from a bottom-up perspective, there are opportunities emerging in the market.
Where are the opportunities? A lot depends on the earnings outlook. What are you seeing? What would you be betting on?
I think across the board, you have seen the interest of several global banks and institutions and taking stake in India's financial sector. You have heard the announcement of Google for a large data center in India. I think the foreign direct investment is turning. I talked about the policy reforms and trying to revive the consumption. And particularly, that has been the segment of the economy that hadn't done as expected. And we have seen a very good festive season. On the investment side, the government of India has been doing the heavy lifting by increasing the public capex over the last couple of years. And with growth momentum picking up, I expect private capex to pick up. So it's going to be a more broad-based recovery than what we have seen in a couple of years back.
What's also been stunning is the IPO market in India. How are you playing that?
Since 2021, domestic institutions have invested $250 billion in market. And now what we are seeing is increasing primary supply. Private equity, venture capital who have been investing in the businesses for a long time are seeing mature businesses ready for exit. You are seeing several of the promoter families and some of the multinationals also accessing the secondary market. India has become a large market. It's a market cap of over $5 trillion, one of the largest in the world. And you are seeing constant flow of the domestic money. It's very interesting that while foreign portfolio investors have been sellers in the secondary market, they have been a continuous buyer in the primary market. So they've also been participating in several of the companies which, and some of them are from new age businesses which are otherwise not accessible in the existing universe.
I'm wondering what could derail retail investor interest in the Indian market. They've been supporting this market for a very long time. What are the risks they could pull back? What would it take?
I think India's retail flows can be compared with the 401k movement in the United States from 1980s onwards. I call this 401k movement of India. The systematic investment plan SIP flows, which are 290 billion rupees a month now, used to be 40 billion rupees in 2017. And it's been a steady increase over the years. I think it's a result of the track record our industry has built over the last 3 decades. It's a result of transparency we have brought into the product. It's a result of technology leveraging on India's digital public infrastructure and making it easier for larger number of investors. And of course, the effort by the industry on investor education, players like us, HDFC, AMC, and all the other players in mutual fund industry have put in a lot of efforts over the last several years to spread awareness about importance of long-term investing, importance of power of compounding, investing for life goals, and so on and so forth. And I think this is a 401k momentum. There would be some cycles depending on the market movement, but I think there is an underlying structural trend which is very similar to, as I said, 401k movement.
And also, there's actually more opportunities for Indian retail investors, right? I mean, we know that they love gold and silver. In fact, Indians are sitting on about $2 trillion worth of precious metals. If that value can be unlocked, that could push the Indian markets even higher.
I think formalization of the economy, digitalization of the economy, digitalization of finance, financialization of savings, and financialization of assets. These are some of the structural, powerful forces underlying in India. And I think all of that, those augur well for our industry. And even today, if you look at the overall household balance sheet, a very tiny proportion has been invested in long-term instruments like equities. So we have a long way to go. This is just the beginning.
In terms of international investors, what's really holding them back? Is it a lack of interest, a lack of opportunities? Is it a case of risk-reward, that they see more rewards perhaps in the U.S. market?
For a long part, foreign portfolio investors owned large part of the Indian market. Over the last couple of years, with rising domestic flows, now ownership is higher with domestic institutional investors, but foreign portfolio investors continue to remain one of the dominant investors in India. I think in the last couple of years, we have seen a strong interest in anything related to AI, and that's why large part of the money going to US. Even some of the other markets like Korea, Taiwan, Japan, China, one of the underlying themes would be something related to AI. I think India has been a little different market, and I think several of the traditional businesses in India would be a big beneficiary of the investment momentum in the world. The investment which is going into data centers, into computing power, into AI, and I think Indian businesses would adopt it very well for their resource efficiency, for cost efficiency, for expanding the business. At some stage when that trade reverses, I'm talking about the momentum on the AI trade, I think India would be a beneficiary. Unlike the previous cycles like late 90s or 2006-07, pre-global financial crisis or pre-tech boom and bust, India almost played the same trade as everywhere else in the world, but this time could be different.
Navneet, we know that SEBI has overhauled the fee structure. What impact do you see on margins and so on?
We have been engaging as an industry with the regulator. They've always been very supportive of the industry. On several forums, SEBI has mentioned that while protecting the interest of the investors, they want industry to expand a lot more. And we remain optimistic that we would continue to work together and take the mutual fund to as many households as possible in India over the next several years.
Navneet, talk to us about how you're positioning yourself for the next 12 to 24 months and what risks you see to your strategy.
I think we are a hardcore bottom-up investors. We don't focus as much on market timing. Sector allocation, again, is a derivative of what we like from a bottom-up perspective or as a risk overlay. And we see a lot of opportunities in India from a structural perspective.
And the risk that you see, Navneet?
I think if something really goes wrong with the global economy, which has implications on India, but I think what Indian policymakers have done smartly is focusing a lot more on boosting the domestic growth through domestic consumption and domestic investments. As I mentioned earlier, government has been doing the heavy lifting on public capex, be it roads, railways, renewables, ports, airports, network, all of those, the building blocks for the economy. And I think from an India's perspective, I see the growth momentum picking up.
In terms of earnings, do you see earnings getting impacted with the changes implemented by SEBI on its fee structure?
I think it's a consultation paper and too early to comment on that.
Right. Navneet, thank you so much for that. Navneet Munot, MD and CEO of HDFC Asset Management. Still ahead on Insight, we're live at the ADIPEC conference in Abu Dhabi. TWG Global Managing Partner Amos Hochstein will be joining us to discuss the U.S. energy policy. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Oil prices are rising for a fourth straight day this Monday after OPEC Plus said it planned to pause output increases in the first quarter of 2026. Morgan Stanley has raised its forecast for the quarter to to $60 a barrel. But Bloomberg's market strategists believe the gains could be fleeting. The group's move highlights that underlying conditions look fragile. Meantime, the U.S. and its allies have ratcheted up sanctions on both Russian producers and its customers. Live now to the ADIPEC conference in Abu Dhabi, where executives, policymakers and energy leaders are gathering to discuss industry trends and the global playbook. Horizon's Middle East and Africa anchor Jumana Basachi is there for us. Jumana.
Haslinda, good morning. Yeah, so great to be here, and so many interesting discussions already taking place here at ADIPEC. I think this year a real big theme is going to be the intersection of energy and artificial intelligence. Lucky for us, we have a real expert from the space, Amos Hochstein, managing partner at TWG Global, and of course, a real specialist when it comes to policy, energy, having worked with the Biden administration. I'm actually going to start with the current U.S. administration's policy on energy and sort of how we've seen somewhat of a pivot versus the Biden administration, and that they're going all in on fossil fuels and hydrocarbons, ripping up the playbook and the focus and emphasis on the green, clean transition. How do you see this pivot? And when you look back, do you feel somewhat disheartened that so much of your efforts have actually been upended?
Well, first, it's great to be here, Juman. Thank you for having me. Look, I think that rhetorically, it's definitely been a huge shift. And we have in America right now, for the last several years, two extremes. The far left talking about it's renewables only and we don't need fossil fuels, while the right says we hate renewable energy and it's only about fossil fuel. And in reality, it's always been and still is that we need it all. The demand for energy, because of artificial intelligence, is growing so dramatically. Yeah. And so even though the Biden administration, we tried to push the energy transition, I agree that it's more of an energy addition than transition. But that means that at the end of the administration, we had the highest level, record level of oil production and gas production and LNG exports because we needed it. So even the Biden administration, despite all the rhetoric, we were growing fossil fuels. What I hope the administration now does is that they don't throw away all this investment in renewables, wind, and solar, specifically because data centers cannot survive on simple reliability-wise, simply on gas. It actually needs the renewables to battery storage in order to support the enormous amount of energy they need and the type of energy they need, which is these reliability levels of near 100%. Yeah. And for that, we need an energy mix.
So Secretary Chris Wright has talked about energy dominance in the U.S. Do you see the U.S. moving into an energy dominant position in the coming years, and not just in oil, also in LNG as well?
I think they missed the boat because we are already energy dominant. We have been energy dominant. At the end of the Biden administration, as I said, record oil production, record gas production, but also record investments in renewables. So we need it all. If you want to be energy dominant, you can't say no offshore wind. You can't say no onshore wind. You can't restrict permitting for solar. I agree with the Trump administration, and I wish we did a better job at this, which was DOE reducing the burden of regulation and permitting timelines. But I don't agree that you can get to where they want to go for energy dominance without the renewables in addition to the fossil fuels.
Yeah, and you don't see the U.S. perhaps shifting focus, derailing the momentum and investment in renewables around the rest of the world. We've got COP going on this week, and many people saying that the fact that U.S. are only sending lower-level delegates there is, a shot in the dark. It's actually really could derail this whole process of what COP is trying to achieve.
Energy dominance means that we are the best at everything across the board. If we walk away from the conversation on renewables and electric vehicles, then China wins because they're already way ahead of the United States in electric vehicles. They're way ahead in solar. We can't let that continue to be because that's where the rest of the world is going. I don't want to have an energy dominant where it's just we're dominant in our own country. I want us to have a energy posture, specifically in the AI era, where we are a world leader. If we're a world leader just for the United States, then we're not a world leader. China is the world leader. So I think we need to engage with the rest of the world and we need to lead at home.
Yeah. How do you read the Trump administration sanctions on the two Russian companies and the likely impact that could have also in terms of presenting opportunities for other markets around the world to fill in the gap?
I am highly skeptical of the Lukoil and Rosneft sanctions. I don't believe in them. Clearly the market doesn't either. The best sanction against Putin, and I have been involved in different schemes to deny oil revenues from the Russians. The only scheme that works is opening the floodgates and allowing prices to come down. Because if the sanctions are effective, then prices go up. If prices go up, Putin wins because he reduces production and exports, but lower than the total revenue generation that he gets from the higher prices. So in effect, if you really want to deny revenues to the Russians, allow the prices to fall, don't do the sanctions, give up on it, and allow to have as much oil as possible on the market and reduce those prices. Who loses? Russia, Iran. And so I think that's the better posture. I'm very skeptical that you can block oil supplies and exports from Russia into countries that don't care about our sanctions.
Amos, thank you so much.
Of course.
That was Amos Hochstein, former U.S. Assistant Secretary of State for Energy Resources and currently managing partner for TWG Global. Haslinda, I'll toss it back to you.
Duane, thank you so much for that interview. Now, New Zealand Prime Minister Christopher Luxon says his country remains committed to reaffirming ties with allies amid rising risks to the global trading order. He spoke to us on the sidelines of the APEC Leaders Summit in South Korea.
I think there's three big shifts that are happening. We're seeing a shift from sort of rules to power. We're seeing very much a strong connection between economics and security. And the third thing we're seeing is a lot more national resilience rather than globally connected supply chains. And that's a function of COVID, it's a function of our economics, a function of a changed trading environment. So there's no doubt about it, the rules-based system that has served us well for 70 to 80 years is challenged. But within that context, we should be incredibly optimistic that we can plot a course and that we can innovate and that we can incubate new ideas as we have done in the past out of APEC. And so whether it's been the FITP, whether it's been the thing that both Mark and I have advocated very strongly for and talked to the Europeans about is to have an EU CPTPP dialogue, a trade dialogue, so that we can reaffirm the rules-based system. Those are important things. But equally, we should be reforming the WTO. We should be doing a bunch of things to make sure that we are relevant and on point and able to deal with the world as it is today.
And Mark Carney's strategy is to pivot to Asia from the US because the US is a much less reliable trading partner for Canada than it has been in the past. New Zealand's obviously very, very dependent already on trade with Asia. Do you have a similar strategy of sort of trying to improve and increase New Zealand's?
Our strategy is pretty simple. As a small trading nation, as we want to do business with as many people as possible and as many places as possible. And so our real focus as a new government has been an Indo-Pacific reset and focus. We see that's where our security sits, that's where our prosperity will sit. That's why we've had over 42 visits, I think, into Southeast Asia alone as a government. But we spent a lot of time in China, in Southeast Asia, in Northeast Asia, expanding our FTA, negotiations with India, obviously closing out negotiations with GCC and the UAE. Building back a strong relationship with Australia and having and playing a role in the Pacific. So, for us, our Indo-Pacific region is both where prosperity and security sits, and both those two things in 2025 are inextricably linked. You can't have one without the other. They are mutually dependent on each other.
And on the domestic economy, the economy contracted in the second quarter after a number of consecutive contractions. Reserve Bank cut rates in October, but Nicola Willis was telling us last month that she's confident the economy is growing this quarter. Are you as confident at the end of the start of November that the economy will return to growth in the fourth quarter? Are rates where they need to be accommodative enough for New Zealand, and what can you do on the fiscal side to help the economy sort of return to growth?
Yeah, look, we're coming out of a recession that's been our biggest recession, I think, in 35 years. New Zealand also had probably one of the longest COVID hangovers. We were the second biggest proportionately spending economy. The previous administration, was a big spending government, taxing more, borrowing more, spending more. Our job is to put the fiscal repair and consolidation in place, and that's what we've been doing. And so I think as fiscal partners, getting control of spending so that we can get inflation down, get interest rates down, get the economy growing, and lower unemployment is a good thing. And we're well on that pathway. We had good growth in Q4, good growth in Q1. obviously the second day of April with Liberation Day, that meant a huge loss of confidence to investors and also to consumers. But we're growing again in the third quarter and expected to accelerate in the fourth quarter. The outlook for New Zealand is very positive. I mean, we are expected to grow 240,000 new jobs in the next 4 years, average probably 2.7% growth, I think 2.4 over the next 2 years as well. So, you know, the outlook is there, but the question now is we don't just want to watch a recovery take place, we want to shape that recovery. And that means for us, we've got a fantastic future, we've got a great country, and we need to make sure it realises all of its potential, and that's what my government's very focused on.
So the Reserve Bank said at the meeting, or the governor said that the economy is still weak and they were looking to cut further. You probably won't comment. If you're happy to comment on where the policy rate should be, I'd love to hear that. But I mean, do you agree with that?
Well, I respect the independence of our Reserve Bank of New Zealand, but you know, they've already forecasted that, you know, they've got one more opportunity potentially to cut rates further before Christmas. And again, what you need is fiscal and monetary policy working in concert together. And so we're doing everything we can as a government to make sure that we're getting rid of the wasteful spending, that we're actually doing our role, so that coupled with monetary policy, we can actually lower inflation, lower interest rates.
And that was New Zealand Prime Minister Christopher Luxon speaking with Bloomberg's James Mager. We're keeping an eye on gold, flooding just above that 4,000 mark after falling below that psychological level. Of course, it is about China scrapping its tax break on gold. Retailers can no longer offset the VAT when selling gold. Spot gold currently at 4,005 and change. Now, before we go, here's a look at our guests for tomorrow. We'll talk markets with GQG Partners Portfolio Manager Brian Kursman. Hear why they're staying underweight on tech despite the blistering AI rally. Plus, we'll be live at the Global Financial Leaders Investment Summit in Hong Kong as we get exclusive insights from M&G Asset Management CEO Joseph Pinto. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.